Hi, and welcome to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. It's a new year, and we're kicking off the season of Financial Minds with Tim Sustak, our SVP Chief Treasury Officer for Vizo Financial, and Scott Wood, our SVP and Chief Investment Officer with Vizo Financial. Gentlemen, welcome. Thank you for joining me today.
Yeah, thanks for having us, Jamie.
Yeah, thanks, Jamie.
All right, so Scott, I'm going to kick things off today with you. So as the yield curve has unconverted or is normalizing, how do you believe that this will impact the credit union industry?
Yeah, thanks, Jamie. And it's a good point. We had a really inverted yield curve for a number of years because the Fed had been raising rates to kind of try to get inflation under control. So they were raising rates, and on the shorter end, rates are going higher, but on the longer end, rates were kind of coming in or staying low. So we had an inverted yield curve for a long time, and finally, as the Fed started cutting rates last year, it started to get more and more normalized. And to help the process, so there's two ways you can go to normalize the yield curve. The Fed can do all the work and cut on the short end and just get us to the point where they're below where the yield, it's normally shaped. It goes higher, up to as the length of time goes out as you buy these longer bonds. So we had that happening. The Fed was doing their part, and then the market stepped in and did the other part, which was they started to raise longer rates higher. So the combination of those two things kind of sped the process up a little bit rather than relying completely on the Fed. The Fed cut 100 basis points of rates last year, right? 100 basis points worth of rate cut. So that moved the short term lower. The markets pushed the other rates higher. So yield curve is positive, normally a positive event for us and for credit unions. It's indicative of the economy being relatively strong, and we're seeing that with the data. The data looks relatively good out there. I'm not saying there aren't pockets of things that are somewhat concerning, but the data looks pretty good. So that's a positive for credit unions. An inverted yield curve is normally an indication that the markets anticipate a recession ahead, a slowdown in the economy. And again, it doesn't mean that we're not going to have a slowdown or recession at some point here, but it's a positive sign that we'll avoid a recession. So good news for credit unions when it comes to lending out money. Another positive aspect of it is, with the normal yield curve, what it means is that credit unions can borrow on the short end like they normally do through checking and savings accounts, short-term accounts at lower rates and lend that money out at higher rates. And that's kind of, the premise of financial institutions, credit unions making money, right? Borrow at a lower rate, lend it out at a higher rate, and the yield curve is cooperating fully with that. Here's the caveat. The downside to this is rates are still pretty high. So while the overnight rate has come down from, the 525 to 550 range, we're still in this 4.25 to 450 range. So you could argue that the overnight rate is still a little on the high end for really low cost of funds. So their cost of funds aren't going to be as low as they would like to see in a normal rate environment. If the Fed continues to cut, and we'll talk about that in our conversation today, if they continue to cut this year, then that'll come down, obviously, and that'll lower their costs a little bit more. We may see the longer rates come down a little bit more in conjunction with that and give them the opportunity to lend out a little bit lower too. But as everybody's fully aware right now, mortgage rates are still very high. When you looked at data from a week ago, the average 30-year mortgage was over 7%. So those are high rates. Even if you're borrowing at lower rates, it's really challenging to convince your members to buy a new home, or they're not going to refinance in most cases, but to buy a new home. So there are challenges with it, but it certainly sets up for a positive year. Hopefully it means a continued strong economy. And if members are borrowing, you're going to have, a positive spread there. And if the Fed cuts more, it'll be even better.
Okay. All right. So then, Tim, based on all of this, what do you anticipate the Fed doing next week? Will they hold?
I think that's exactly what they'll do. To me, and I think a lot of people feel this way. It's a perfect time to take a pause. Latest readings we got on jobs, a little better than expected, obviously, in job creation. CPI core came in, surprised to the downside a bit. The jobs market is still, doing well. Certainly, not overheating and not getting crushed by where rates are. Inflation still, if you want to see it that way, is still trickling down. And the big thing is obviously we have a new administration here coming in. So with some policies obviously that are up in the air as far as what exactly do they mean for the economy and how do they affect inflation and everything. So I just think that I think the numbers, certainly current numbers anyway, give the Fed the opportunity to pause. I think the markets certainly would feel like they're giving them the opportunity to pause. And with the administration coming in, I think it's a great time to pause just to kind of collect thoughts, see where these recent rate decreases have taken us, how they're affecting things, and see exactly how this new administration and policies start to form out. Um, I think it's a perfect time. So that's certainly what I expect to see. The Fed certainly can't just look short term, right? They can't just look at what's happening now. They need to certainly look much longer term than that. Obviously there's some disagreement there. I mean, here's the Fed governor's talk and Fed president's talk. You certainly hear two sides of that coin. Some that think, well, we're still going to need to cut rates. I think for President Waller came out and mentioned what I think he was thinking maybe another 4 times. Others have come out and said, hey, we're not sure. We think inflation could continue to be a problem, maybe less. So, but I think they all agree that the data is going to dictate that. So, we shall see. But short term, I think, yeah, definitely a pause. And then we'll see how all these things start to affect the economy that the new administration is going to bring in and how this data transpires to get a little better read on what's going to happen longer term and, how many cuts we may see or not see this year.
Okay. All right. Well, thanks, Tim. And I just make a note. Next time that we're on this podcast, I will be asking you about the impact of the new administration. So that will be a follow-up question. Scott, I can't imagine that you're going to have a difference of an opinion, but thoughts on Tim's assessment for next week's FOMC meeting?
A 50 cut at least. No, just kidding. I'm with Tim. So the data was kind of getting to the point last year where it was kind of iffy, like the December rate cut. I think a lot of us thought maybe that wasn't necessary, because the job numbers have remained strong. The unemployment rate is still in a really good spot. We're still producing jobs, a couple 100,000 plus every month. So that the jobs data is looking really good. And then the other side of that is we were starting to see inflation get sticky again. Where not that it was going higher necessarily, although a couple readings did tick a little bit higher, but really it was just kind of hanging out and wasn't moving lower towards that 2% Fed target. So maybe they could have paused in December, but certainly they'll pause at next week's meeting on the 29th. It's a definite. I mean, it would, barring something crazy happening, which is not going to happen between now and then, despite how you feel about the incoming administration. I don't anticipate anything crazy happening in a week. And as Tim pointed out, the new administration is just another reason to kind of sit back and pause, see what happens. There's been a lot of talk about tariffs. And I'll point out that, when Trump was president, he instituted some tariffs against China and other countries. What's not talked about a lot is that Biden kept a lot of those in place. And in some cases, he actually increased the tariffs. And the difference, I think, between Trump's first term in office, and now is he entered office at a point when we didn't have inflation. It wasn't a concern or an issue. He's entering now where we've had it for the last, let's say, really since the pandemic. That's kind of when it kicked in. So it's been an issue for the last 3 or 4 years. So he enters at a little bit different point with inflation. So maybe his tariffs, and certainly if he introduces new tariffs, they could have a little bit more of a meaningful impact than they did last time. I would say last time they were, I don't want to call them meaningless, but we didn't see really a movement in inflation to the that was concerning when he was in last time. So it is a little bit different this time, and there's certainly room for that. But the data continues to be to say it's a good time for the Fed to pause. The latest employment reading from December data that was published in January, still really strong, much stronger than anticipated, actually. So a good report. And inflation has been the same thing. It's just kind of holding out there. We've seen a little bit of a drop in CPI, but it's not moving really much. We're still above that Fed's target. So good time for them to pause. The big question is, what's the next move? Most folks think it's still going to be lower rates, but when are they going to make that move? And when you look at Fed fund futures, which is, what the market, they place the bets, they're actually putting money on the table, and it's saying basically the June meeting. So the Fed will be on hold for another 3 or 4 meetings potentially. And the other part of this is the markets right now are not fully baking in 2 rate cuts this year. They're only fully saying 1 rate cut of 25 basis points and no guarantees of that second rate cut. And as Tim pointed out, we're early in the year where we haven't even started this new administration. We don't know what's going to happen. Inflation could just start to tick down. There are issues in China, economically speaking, that could push prices lower globally, but there's still a lot to know. You can't look at Fed fund futures for the whole year right now in January and be content, but certainly the markets have backed off of aggressive rate cuts this year too. So probably a pause through the first quarter.
Okay. All right. Well, let's pivot a little bit. Tim, I want to talk about liquidity. So how are credit unions on the liquidity front? I know in the last podcast together, we discussed the bank term funding program, which ended back in March of 24. But financial institutions had that 1 year from that date to repay the advance. Are you seeing those repayments? Is it having any impact on liquidity?
Yeah, so overall, I would say liquidity remains strong in the credit union movement for credit unions in general. I mean, there's outliers, obviously, all the time, but in general, liquidity is good. Knock on engineered wood. But yeah, I mean, to your point, Jamie, we have seen payments on those bank term funding loans. I think there's obviously two sides to that coin, right? If you took that money down, just because you weren't sure, you wanted to have a little bit extra liquidity, you're going to leave it sit, and get a bit of a positive arb out of it, then certainly that kind of went away with the November rate decrease, right? So you see a lot of those credit unions who just had that money sitting have certainly gotten rid of that. The credit unions that took it because they really did need funding, a lot of those folks, I think, at least some of the credit unions we talked to, switch funding sources, right? So maybe they had a longer term loan out, with the FHLB, and chose to, close out a loan that they had, or, and replace that with a bank term funding loan. And now what they've done is said, hey, we'll pay off the bank term funding loan and prepare to go back the other way and have secured funding some other way. So, yeah, I think we've seen a lot of that. Get paid down, and we'll continue to see that. But so far, it has not appeared to have any significant effect on liquidity. Like I say, I think credit unions either had that money sitting and were able to just kind of give it back, so to speak, or, have looked at it, thankfully, soon enough and not got caught here at the end of the term of these loans to, do some balance sheet management and construct other funding sources and get that money taken care of. So far, so good. We'll see how to your point, they've got till the beginning of March to pay those off. But, from what we've seen, I think people have addressed that early, and seems like we should be in good shape there.
All right, good. All right. So, Scott, you kind of talked about this a little bit earlier. Credit unions are in the business of lending, mortgages, home equities, auto loans. What should credit unions be watching, and what could the impact to this line of business be for them in the coming weeks or months?
Yeah. I talked a little bit about it, kind of alluded to a couple things. So I guess the wild card is, what's lending going to be like this year? Or what's demand going to be like from your members? What are they going to be looking at? And from everything that we've seen and heard, auto purchasing, buying cars is going to be pretty strong again this year. We think there'll be good numbers. Most of the credit agencies and the car manufacturers think it'll be a good year for buying cars again. There'll be strong demand. So that's kind of the bread and butter for a lot of credit unions, or for most credit unions, doing new and used auto loans. So especially on the used side. So there should be strong demand for that. The good news too is you should still be able to get really pretty attractive rates. When members are borrowing, the 199 and the 299 rates that we had a couple of years ago, maybe 2 or 3 years ago, those are not in the foreseeable future. So you should have some pretty nice spreads there. There should be strong demand from your members, which you may be up against, and we'll see how it goes as the year progresses. But some manufacturers have been starting to offer some lower loan rates to drum up volume, but they're still not. I haven't seen any 0% kind of things yet. So that's all positive for credit unions. So hopefully auto lending will be really strong again, a strong area for credit unions this year. Home equities is another area of potential strength. There's a lot of equity in homes. There's a lot of homes that have $150,000 to $250,000 worth of equity in them. I want to say the average home equity right now, as far as what's available to be tapped into, is over a couple $100,000 across the nation. So that means there's a lot of room for credit unions to lend out on the home equity side of things. And because mortgage rates are higher, it is discouraging some people from selling their homes and getting rid of these lower mortgage rates they have. If you have a sub 3% mortgage, you're not really incented to sell your home and buy something else at a 6.5% or 7% mortgage. So what that means is a lot of people are doing home renovations. And a great way to do that is to tap into your home equity. So there's real good opportunities there. The area that's going to be tough this year, based on what we're seeing today, is going to be just first mortgages, to do those initial home loans, because of that lack of demand. There's less homes available on the market, although new homes production has been a little bit higher this last month. But that's going to be the real challenges, are mortgages. But there should be some good strength in autos and home equity lines.
All right. So, Tim, what else should credit unions be looking at in the coming months, regarding the economy and the markets?
Well, I guess in my head, the big thing is, don't become married to the rate decline narrative. Certainly, I think we still expect rates to fall somewhat. Some people think more, some people think less, but to Scott's point, we really don't know what. There's a lot of variables going into it. Obviously, there always is, this year particularly, and you really don't know what's going to happen. There's been some talk about possible, hey, do we see rate increases this year rather than decreases? And I just think that credit unions need to not fall asleep on that and just kind of become married to this, short rates are going to go down narrative. So, when you're taking a look at balance sheet management, certainly consider both sides of the coin when it comes to, the Fed and short-term rates and how they're going to move. Same thing with the longer end of the curve. And, what does that mean for your deposit base? What does that mean for strategies for lending and for liquidity? So just make sure you're looking at all of that and not, just becoming, thinking we're definitely going one way, because I think, if any year's the year we could see some surprises this year. There's a lot of things cooking out there with geopolitical things and new administrations and, certainly our own economy and other economies as well. So to state the obvious, but yeah, just consider all sides of the coin.
Okay. All right. Scott, any final thoughts for our listeners today?
Yeah, I think, beating the drum again, Tim and I have talked about this a lot over the last few months, but, as far as rates go, pay attention to what the Fed's saying and doing. They've been really good at telegraphing, or telling, not even just telegraphing, being straight with us and telling us what the plans are. So continue to pay attention to incoming data. So that would be the employment, look at the unemployment rate that comes out on the first Friday of every month, the unemployment rate and the number of new jobs created. That official report is big. And then the other thing is to look at the CPI and the PCE numbers and see what inflation is looking like. If inflation gets to be sticky, then count on rates not moving a whole lot lower this year, as long as employment remains strong. But if we start to see a weakness in employment and PPI, are these inflation readings continue to come lower, then certainly the Fed has room to move move rates lower. As Tim said, there is a little bit of uncertainty. The Wall Street Journal had an article a week or two ago saying that, the chance of, nobody is saying that the Fed's going to raise rates this year, but there certainly is that probability that it could happen. Maybe if inflation doesn't remain calm, and if employment numbers continue to remain strong, they may have to do a cut. Again, not super likely, but it's possible. So I would say just continue to listen to the Fed, pay attention to those couple of readings that we've talked about, and kind of let that guide your decision making.
Okay, thank you. Tim, any final thoughts?
Yeah, I think we've covered it.
All right. Well, before I get to the who sponsored today's episode, I do want to just make a pitch real quick. If you like what you hear from these two, Scott Wood will actually be at our financial strategies workshops coming up here in March and April. So he will be doing his economic update. So find out more information on Vizo Financial's website. And maybe you can even get his autograph while you're there, because you will be in person. So as always, thank you both so much for joining me today. I really do appreciate it. This episode of Financial Minds is brought to you by Vizo Financial's Risk Management Conference. In a world where risks evolve as quickly as solutions, credit unions face a relentless challenge: staying ahead of the threats that target their operations, their members, and their reputations. Vizo Financial's 2025 Risk Management Conference will be held April 14th through the 16th and will take you to the forefront of the battle against these threats, from cybersecurity to fraud, compliance to continuity. Get armed with the tools, the insights, and the strategies to keep your credit union agile and resilient in the ever-changing world of risks. Join this year's Risk Management Conference in Hershey, Pennsylvania, so that your credit union can learn to think about risks creatively, plan strategically, and lead confidently. More information is available on Vizo Financial's website at www.vfccu.org. As always, thanks for listening, and make it a great day.